Good morning. I'm Christian Hoya, and this is my colleague.
Hi, I'm Alicia Daniel.
We currently have been asked to provide assistance in determining proper accounting treatments for this life settlement contract. Emilio currently provides employees with the option to purchase their life insurance policy under a life settlement contract. Chuck has recently retired and elected the life settlement contract option. So currently his cash surrender value is $1.2 million and monthly premiums are $200. It has been brought to our attention that the controller and CFO disagree on the correct treatment, and we are here to assist. So in this meeting, we want to provide you with a general overview of what a life settlement contract is, the accounting options, the advantages and disadvantages of each options, and our recommendations and the financial statement impact of the selected alternative. So first, let me give you an overview of what a life settlement contract means. A life settlement contract is usually a transaction where the life insurance policy owner sells the policy to an investor for a lump sum payment. Usually the payment is generally less than the death benefit, but more than the cash surrender value. The investor, you in this case, should consider the life expectancy, the age, and the health of the insured. So in this case, Chuck, and the terms and conditions of the insurance policy. Many reasons exist for the insured to sell their policy. Family changes and financial difficulties are two reasons. Now that we have a definition for what a life settlement contract is, let's look at the accounting standard codifications in 325-3020 that states the characteristics. First, the investor does not have an insurable interest. Second, the investor provides consideration to the policy owner of an amount in excess of the current cash surrender value of the life insurance policy. Third, the contract pays the face value of the life insurance policy to an investor when the insured dies. These characteristics meet the qualifications for Chuck and Emilio for a life settlement contract.
Current GAAP allows investors to choose between two different accounting alternatives when accounting for a life settlement contract, either the fair value method or the investment option. The election must be made on an instrument-by-instrument basis, and once an election is made, it is irrevocable. Also, management must document and support the election, and these must be included in the disclosures. Or they can preset an existing policy in order to continue accounting for life settlement contracts in the same manner in subsequent periods. First, we discuss the investment method. The investment is initially measured at the transaction price plus any direct external cost. Continuing costs such as premiums and other direct external costs are capitalized as well. A gain will not be recognized until the insured dies under the investment method. First, the gain would equal to the difference between the asset's book value and the policy's proceeds. The investment will be tested for impairment if any indication of impairment arises. When an impairment occurs, the loss is the difference between the carrying amount and the fair value measured using current investment rates. Next, the fair value method, and there are multiple differences between the fair value method and the investment method. The investment is initially measured at the transaction price only. Direct external costs and additional costs to acquire the contract would then be expensed rather than capitalized. The investment is remeasured at fair value in subsequent periods, and any changes are recognized in earnings. Now that both methods have been explained, we detail a comparison between the two. The fair value method provides a few benefits, but mostly disadvantages. First, both the asset and income are increased over the life of the asset. Also, there's a lack of an active trading market upon which to base measurement, and therefore management is required to use a good faith model. This causes results to vary from period to period and also from entity to entity. Lastly, life expectancy estimates for terminal illnesses are generally not known and not published, and we're uncertain of the level of Chuck's illness. Therefore, with all of this in mind, the fair value method would be very difficult to implement. The investment method provides mostly benefits with one disadvantage. First, the asset value is consistently increased over the life of the investment because the premiums are capitalized on a monthly basis. Income is not recognized until the insured dies, so income is never distorted. However, the impairment testing does generally ignore that investors typically are unaware of changes in the investor's health, and it also ignores the associations that guarantee funds are given to the insured. Both methods provide different pros and cons, but the benefits of the investment method far outweigh that of the fair value method. We believe, after intensive research, that the investment method is the best alternative for management in that it provides four main benefits. First, the asset, and thus the balance sheet, is consistently increased by the monthly premiums. Secondly, it reduces volatility in earnings in that income is only recorded when the insured passes. Thirdly, it provides comparable results without any income distortion. And lastly, it is easier to implement because no subjective measurements are required. Accordingly, the financial statements will be impacted. First, the balance sheet would contain the asset account, valued at the summation of the transaction, direct external cost, and the continuing costs, since all of these are capitalized under the investment method. On the income statement, losses from impairment testing would be included with continuing operations. Gains are recognized in earnings only when the insured passes. Investing cash flows on the statement of cash flow would include cash paid for the initial investment and any premiums, and the return on the premium amount. And operating cash flows would include income from the investment equal to the excess of proceeds over the cash invested. Management is required to disclose the following: the elected accounting policy, the number of life settlement contracts, the carrying value of these contracts, the face value of the life insurance policy, the premiums anticipated to be paid to keep the contracts in force. All of these are based on the remaining life expectancy for each of the first 5 succeeding years. Now, I'll hand it back over to Christian for the suggested journal entries.
For an initial investment, the journal entry that needs to be made to capitalize the initial investment is a debit to an investment asset account for $1.2 million of the cash surrender value. Also, we need to credit the cash account in the period that the investment was made. This is under the assumption that the cash surrender value is at contract cost, and no broker or other direct costs were incurred. Also, the same entry would be made monthly for the $200 representing the capitalization of the premium payments. Any gain will be recognized upon Chuck's passing, and the gain will equal the difference between proceeds received, in this case cash, and the carrying amount of the investment, which is the original investment plus capitalized premiums. The impairment testing will be performed when indications arise, so a loss account will be debited for the amount equal to the fair value, less the carrying amount, and then the investment account would be credited for the same amount. Further, management will be required to provide documentation that supports this election, and an additional option is to follow or create a pre-existing automatic election for the similar investment. So with all this said, we have concluded our discussion. Again, we believe the best option for Emilio is to elect the investment method for the investment in Chuck's life settlement contract. I just want to thank you for your time, and if there's any questions or comments, please let it be known. Also, we'll be glad to discuss our recommendations further and will follow up on your decision. Thank you, and I hope you have a good rest of your day.